I want you to imagine something. You open your banking app tomorrow morning. Your money is still there. Same balance. Same account. Nothing appears missing. But when you try to transfer money, nothing happens. You try to withdraw cash. Declined. You try to pay your rent. Declined. You call the bank. And all you hear is, access has been temporarily restricted. No warning. No preparation. No timeline. As unbelievable as that sounds, something very similar has happened to ordinary people multiple times throughout modern history. Different countries, different governments, different decades. But every time, the people affected thought it couldn't happen to them. Tonight, we're going to look at 4 real banking crises that changed people's lives overnight. Before we get into the stories, we need to understand one important idea. Most people think the money in their account is always available whenever they want it. And most of the time, that's true. But history shows there are rare situations where governments, regulators, or financial institutions impose restrictions during periods of severe financial stress. Sometimes those restrictions last days, sometimes weeks, sometimes much longer. Now, to be clear, these situations are unusual, but they are real. And that's what makes these stories worth studying. Because every person you're about to meet believed they were living through normal times, right up until things changed. And the most shocking example of all happened in Europe in 2013. We'll get there in a few minutes. But first, we need to go back to 1931. Vienna. Spring of 1931. A merchant named Heinrich had spent years building a successful business. His inventory, his payroll, his working capital. Everything depended on one institution. Creditanstalt. At the time, it was one of the most important banks in Europe. Trusted, established, respected. Then the crisis began. As financial problems spread through the banking system, confidence started disappearing. Suddenly businesses found themselves unable to access the money they depended on. For people like Heinrich, the damage wasn't theoretical. Employees still needed paychecks. Suppliers still expected payment. But the financial system was breaking down around them. Heinrich eventually had to let employees go. Not because his business failed, but because the system around him did. And that distinction matters. The collapse of Creditanstalt helped trigger a wider banking crisis across Europe. And what happened next taught a lesson that would repeat again and again throughout history. People don't prepare for banking stress because they assume stability will continue. Until it doesn't. Now fast forward more than 80 years. March 2013. Cyprus. A restaurant owner named Eleni finishes another normal workweek. Business is steady. Customers are coming in. Life feels ordinary. Then the weekend arrives. And everything changes. Banks close. ATMs impose limits. Account holders suddenly discover they cannot access money the way they normally could. As part of a rescue agreement involving international institutions and the Cypriot government, large uninsured deposits faced losses. For many people, this was the first time they had ever considered a question they thought they would never have to ask. What happens if access to my money becomes restricted? The shock wasn't just financial. It was psychological. Because only days earlier, nothing appeared unusual. And that's what makes this case so powerful. The people affected weren't reckless speculators. Many were ordinary business owners and savers. But here's the question that should bother all of us. If you had known 1 week earlier what was coming, would you have done anything differently? Keep that question in your mind. Because the next story takes us to South America. Buenos Aires. Late 2001. An accountant named Roberto believed he had done everything right. He worked hard. Saved carefully. Avoided unnecessary risks. Then the government introduced restrictions that became known as the corralito. In Spanish, corralito means little fence. And that's exactly what it felt like. A fence around your own money. Built overnight. Without warning. Withdrawals were limited. Access became restricted. Millions of Argentines suddenly found themselves unable to freely use their own deposits. For Roberto and many others, the experience was devastating. Not because their account balances disappeared overnight, but because access to those balances changed dramatically. The crisis eventually reshaped an entire generation's relationship with banks, savings, and financial institutions. And perhaps the most important lesson from Argentina was this: financial crises rarely feel obvious before they happen. Most people only recognize them in hindsight. Which brings us to the most recent example, and the one many viewers probably remember. March 2023. California. A startup founder named Marcus manages payroll for dozens of employees. His company banks with Silicon Valley Bank. Then concerns begin spreading through the market. Depositors start moving money. Confidence disappears. And within days, the bank fails. Regulators step in. Account access becomes uncertain. Businesses across the country spend an anxious weekend wondering whether payroll can be met. Eventually, regulators invoked emergency powers to protect all depositors, insured and uninsured alike. But for those anxious days in between, the uncertainty was completely real. Thousands of businesses faced a reality they never expected. Money visible on a screen, but uncertainty about when it would be available. And that's what makes this story important. Not because it became another Great Depression. Not because it became another Cyprus. But because it reminded people that banking systems rely heavily on confidence. And confidence can change very quickly. So what connects all four stories? Different countries. Different decades. Different economic systems. Yet the same three patterns appear again and again. Number 1. Most people assumed things would remain normal. Number 2. The warning signs often looked insignificant at first. And number 3. By the time the average person realized the seriousness of the situation, most of the important decisions had already been made. History shows something fascinating. The people who navigated these periods best weren't necessarily richer. They weren't financial experts. They simply paid attention earlier. So what can we actually learn from these stories? Not panic. Preparation. Historically, people who handled financial uncertainty well tended to focus on three things. First, avoiding overdependence on a single point of failure. Second, maintaining financial flexibility. And third, paying attention to risks before they become headlines. Now let me be very clear. This video is not predicting a banking collapse. And it isn't financial advice. The situations we've discussed tonight were specific historical events. But history matters because it reveals patterns. And patterns help us ask better questions. Heinrich in Austria. Eleni in Cyprus. Roberto in Argentina. Marcus in California. None of them expected their lives to intersect with a banking crisis. And that's exactly why their stories remain relevant. Because the most dangerous assumption in finance isn't that something bad will happen. It's believing that unusual events only happen somewhere else. If you found this breakdown valuable, subscribe. Because in the next video, I'm breaking down the exact decisions that separated families who recovered from 2008 quickly from those who are still feeling it today. The difference comes down to 3 specific moves. Subscribe my channel, because that video is coming next. And if tonight's stories made you think, that one will make you act.